conversational as possible. So if you have a question that's burning throughout, feel free to ask it as we go. We'll still have time at the end for Q&A. But to start extremely broadly, as an independent, maybe small to medium size label, what are the options available, and where do you start thinking about potential financing opportunities?
Well, from us, it's pretty early on. It could be from an individual artist that you're trying to acquire or trying to retain. It can be a couple approaches. It can be a white label where we're giving them the funding that they need to provide a zero cost, zero fee advance to the label or distributor, or it can be as a pass-through where they're offering the creative the financing at a much lower rate on just the financing they're receiving, and then a more competitive distribution rate. But they can come to us from very early on, or they can look at their whole catalog and leverage that as well.
Yeah, I think we're similar in that sense. We can work with an artist down to $250 advances, all the way up to seven-figure advances to labels. And again, if we're working with a label, it's really about the structure that works for them, that is going to be completely understandable to them, so that they can base their decisions off of predictable cash flows, whether that be a percentage base or a full recoupment at 100%. We can kind of run the full gamut there. And I think one of the differentiators for us is not going out more than 2 years, so that we can keep the cost of capital down as much as possible, so that you have similarly priced money to really the rest of the business world.
I think, Sam, if you want to look at the range of options, right?
Yeah.
One is bank debt, but I think probably good luck taking your distributor statements into a bank and saying, hey, can you advance against this? Most bank managers don't really know what they're looking at in that case. Second is some sort of equity funding, right, where you're taking investment in your business. Obviously, you're giving up part of the business to do that. Third would be to get money from a distributor, which I think is quite common. The one thing I would caution against in that sense is when you take money from a distributor, you're then tied to that distributor, right? And if you decide that the key person you liked at the distributor or their service level's gone down, you don't have much to hang over their head if you've taken an advance from them. And then the final option is to come and talk to one of us, or maybe all of us, right, and look at all the options available, which hopefully give you the most amount of flexibility in the situation.
Yeah, I would say that. I think from the Duetti perspective, I think we're probably the only service that's completely backward looking in that regard, right? Because we're only acquiring existing masters. So in a way, you're allowing, you have an ability to hold on to your future earnings, right? And you can portion out how much of your past you want to give up, so to speak, right? And I think that's quite different, right? In the sense too that you're selling something, so you have an opportunity to take kind of a straight asset transaction as opposed to any type of any kind of debt, right? In any sense. But I fully agree that you should really look at all the options at the end of the day and see what makes sense for you, and how much money you need, and what really you're getting in addition to the capital, right?
And I think from the label perspective, it really comes down to what do you need the money for? Because if it is for artist advances, I think a lot of the different products and services that you all provide are beneficial. If it's for working capital, then that's a different story. And so I think debt or equity from other sources might be the better strategy.
So on that point, how do you care about use of proceeds? Do you like to have oversight into what the financing is being used for? How does that influence your decision making?
So that's actually one of the benefits of selling masters if you do own them, right? Or if you want to partner with an artist to sell their masters, we don't care at all what you do with the money, right? It can be used for working capital management. It can be used for A&R. It can be used, I don't know, to furnish your office, right?
Yeah, I'm curious about everybody's answers to this, because we're the same as Duetti in the sense that we're not buying, we're financing, but we're backward looking, and we don't look at specifically what the use of funds are. Right? And so I'm not sure.
I think it's the same for all of us. I don't know if anybody wants to be like, no, I'm poking in your business and making checking on what you've done with the money.
No, it may not be poking your business, but it may enable them while they are able to see into the futures and see the benefit, which I think you guys do a good job of. And so you are asking a little bit of use of funds for projects because it's a good thing because you can then finance on the futures, right?
Right, yeah, so we will advance against future work as well as against catalog, but although we only pay that advance out when those tracks are released, how it's marketed or what they actually do with the money is, yeah, we're not looking at that.
Yeah, we don't necessarily dictate anything with regard to use of funds, but what we have tried to do is provide a ecosystem of good places to use the funds. One of those examples we'll be announcing actually here in the next couple of days, a partnership that allows you to actually recoup up to 10% of dollars spent on a platform, helping move your initiatives forward back to recoup against your advance, which would otherwise have been a revenue share that RoyFi could have collected. We said, no, actually, this is a really good thing for everybody from an independent artist up to a label to a distributor to have access to and be able to de-risk their advance as well as their investment into to marketing.
And I'm curious, Alex, to your point, if you are looking at forward-looking cash flows, right, from something that hasn't been released yet, for example, is there a conversation around the creative as well that takes place then?
No.
So the forward advance happens purely based on the past performance?
Correct, yeah.
Are you guys doing futures?
No.
Yeah, we aren't either.
Yeah, I think it's just.
STEM does, obviously.
Yeah, STEM does. But we actually take a different perspective. We do, we have a pretty engaged creative team, and definitely look at, try and listen to the music, try and get an understanding of the release plan. But as you mentioned, Matt, definitely historical performance does dictate, and that kind of leads me to the next question. I think, there's been an emergence over the past 5 years of fintech companies like ourselves that are, providing these unique financing opportunities. Kind of born out of this, a number of reasons, but one of them is a lack of understanding of this industry, particularly from traditional financiers like banks and private equity. How do all of these perspectives reflect in underlying catalog valuations? How does a beatBread or a Sound Royalties differ from a bank or a VC company, and how they would look at a potential opportunity like this?
I don't know a lot about how the banks do it, Sam, but I think it's based on a fairly simple cash flow model, right? They look at the cash flow, they make projections based on that. We've spent years now we've got 10 people on our data science team who are constantly revising an algorithm which is making projections on individual tracks, right? How each track is going to perform over the next 8 years. That's what all our advanced offers, all our models are actually based on. Pure data science, and by people who've spent months and years studying it and perfecting it and testing it and all of those things. I imagine the banks and the big sort of catalog purchase companies are working with something a little more basic.
Yeah, I think from a bank's perspective, what we're seeing is they're providing the financing and they're looking at the past history, but they're doing it through valuations and forecasts from Citrin and Cooperman and people like that are going to charge them for that valuation. We're doing, like you guys are, our own analysis of the history of the music and then forecasting in the future what it's going to earn. The other big difference from dealing with a bank, which is valuable and they offer a lot of benefits, is you're going to be offering personal guarantees. You're going to be pledging all of everything as collateral.
Right.
And that's, I think, a big difference from the people that are up here. There's no personal guarantees from the most part that I'm aware of. And from our perspective, Sound Royalties, there's no personal guarantees. We're not looking at your other assets and we're not looking at your credit. We're looking more at the music itself and its performance historically and what we believe it can do in the future.
Yeah, and you have to have that central thesis or that central understanding that, music at every level or at every size, so to speak, right, holds long-term value. And I think, the core finance community can understand that a Bob Dylan catalog will hold value for the next 20 years, right? But one of the core sort of hypotheses or theses behind Duetti's business is that applies to all music, right? And I think, it's really easy for everyone here in the room to understand. If you're in love with a track that you listened to when you were in your teens, it doesn't matter how big that artist was when you fell in love with that track. You're still going to listen to it forever, right? And that's something that I think, no offense to any bankers, but that's something that they don't necessarily see, right? And then I think in addition to that, getting access to those artists, right? There's a market mismatch there, right? The artist isn't going to be able to find that banker or necessarily be able to engage in that conversation. The management team might, but depends on the artist, right? Depends again on the level of the artist and things like that. And the bank isn't going to be able to reach out to those customers in the same way that maybe a music company can, right?
Yeah, I mean, the banks are typically working through the business managers and the entertainment attorneys just as we are, but their floor, that's what you're going to see as a difference. Most of them want to do seven-figure advances, and if it's smaller than that, it's just not cost effective.
Correct.
I think, our floor is $5,000 a year in royalty income from any given stream, and we draw that floor because we're not using the tech to communicate with the customer or their team. It's one-on-one customization and conversations, so that, full transparency and understanding.
Yeah, I think I think it's probably the basis of all of our business models is that these royalty streams are repeatable and are understandable from a risk perspective. And I think I would push back a little bit, and I would say I think that the banks are starting to understand it. I mean, they're clearly understanding it on the catalog acquisition side. I think they're understanding it at scale for advances. That once you build a big enough book of these advances, that it is a bankable asset that companies can go and get a line of credit against. The biggest thing I think for them that's going to kind of keep all of us in business is exactly like you guys said, the floor. At the end of the day, banks are regulated entities. They have a certain level of red tape that is going to keep them out of a $500 advance. It's never going to be efficient for them to put a UCC1 in on an artist for $500 and then go and enforce that. And I think that's the opportunity for all of us. The question then becomes what does the cost of that money to the artist have to be? And I think with more and more data and obviously this shift to streaming has absolutely increased the amount of data that we can see and use to underwrite, and materially changes the risk profile from what it was 10 years ago. And I think that's what we're trying to bring to the market is a more risk-based approach and cost of capital, because at the end of the day, even an artist that has got $2,500 a year in earnings has a repeatable catalog.
Yeah, that's right. And I think just to really quickly jump in on that, Peter, you're right. It's the floor, but it's also that, to your point, Matthew, like a bank doesn't have 10 data scientists working on a model to predict that, right? And so one of the things that Duetti can do compared to anybody doing catalog acquisitions too, from what we see, we're not looking at catalogs that are 10, 20 years old, right? We're looking at catalogs that might just be 2 years old. We started tracks 2 years old. And you can't just take a 3-year average times 8 on a 2-year-old catalog, right? So that's another big difference, I think, in addition to the floor, which I fully agree.
All right. Well, just on that point, after a deal has been done, and Chris, I'm curious for your perspective on this as well, particularly after an acquisition. After a deal has been done and the money's been paid, how do you think about finding new value for that revenue stream moving forward throughout the term of your deal? And the question's open for everyone, but I'm curious from an acquisition perspective first.
Yeah, I mean, I think we start by just crossing the T's and dotting the I's, right? Making sure everything is well distributed and available on all the right platforms, be it the social media platforms, be it TikTok, be it Instagram. And from there, we really look at data, right? Simple things, or seemingly simple things, like, hey, we've got an Afrobeats artist who's doing really, really well in the UK, but we know Afrobeats is a growing genre in the US. How can we get a little bit more visibility for that track in the US? Now, the big difference for us in catalog marketing, and this is a big deal for artists and a big part of, I think, the appeal, is that we're not trying to break any tracks because we're not focusing on any front line, right? That's the big difference between us and what labels do, and I think that's actually where we can really be great partners, right? Because we can help labels with their catalogs as well, just like we can help artists, right? And while very few labels have time to be fully focused on marketing their catalogs, it's the only thing we do. And so we do use a purely data-driven approach there, and we use purely ROI positive methods. We partner with TikTok, we partner with Spotify, and we've tried our hand at Sync as well, but that's everybody knows about that, right?
Right.
And from a sound royalties perspective, since we're not looking at what the use of the works are, we're not putting covenants on how it's going to be used, we're not helping in that area, but at the same time, no, I just lost my train of thought. Yeah, well,
I'll just jump in and say, Alex, we don't do anything, right? We provide funding and we say we get out of the way. So very different to Chris, but that's our approach, is just provide the funding and leave people to it. We're not offering any services.
and the same, and that was, thank you, Matthew, you helped me there. So from a sound royalties perspective, we're not competing with the publisher, label, distributor. We don't do any of that, and that's kind of the balance of the relationship, right? We're leaving you to do what you do best, and we're coming in from the finance perspective.
So to that point, you guys are separate to the distribution side of things. Does a manager's or label's decision on their distribution service influence your process?
It can a little, Sam. There's a few distributors who basically refuse to work with us, right? They just won't accept a letter of direction, so that's the end of that conversation, basically. The second is, distributors are charging some very different percentages out there, and we will generally point out to somebody who's paying a 30% distribution fee that if you move this to a zero-cost distributor, your advance will go up by 30%, right? So that's part of it as well. And it really depends on the technology the distributor has as to how much control we need to take over the account. We're always making sure we get paid at the distributor level, so we're not collecting from the label or from the artist. I'm trying to collect from artists on a monthly basis. I don't think you've been in business very long, right? No offense to artists, but they're not super organized most of the time. There's lots of sort of different intricacies, but generally we like to say we give artists and managers and labels, for that point, as much freedom as possible of choice of distributor, and therefore what I talked about at the very beginning gives them that extra leverage over their distributor, right? That if the distributor's not delivering what they said and they've taken advance from us, we'll let them move the catalogue during the term. Whereas if they took the advance from the distributor, they're stuck with that distributor. So lots of different, sort of small variations, but overall a lot of flexibility.
Yeah, I think this is where there's a lot of nuance in the industry in general, right? And fully agree with you, right? There are huge you can have you can be making $1 million in streaming on a DistroKid track, right? Or you can pay 0%, or you could have gotten $5,000 advance and are paying 40%. And I think the difference from our perspective, and this applies not to take us back to the marketing, but that's where the marketing piece comes from too, is at the end of the day, Duetti is a catalog owner for the long term, right? So it's in our interest to market. And similarly, it's in our interest to make sure that distribution fees are extremely low, as low as possible. So we don't try to get in the middle of where your current catalog is, but again, it's advantageous to you if you allow us to move it for you or with you.
I guess that makes sense if you're going to be providing the marketing and some of the other services that maybe a STEM or a beatBread would provide, because not all distributors are made equal. So you might have a distributor that they'll put the content up on a DSP, but they're going to do absolutely nothing else.
Right.
And so if you're encouraging people to go to the lowest fee and not necessarily where they can get the best exploitation, that may not be in their best interest either.
You might be right, but I guess, Tony, my question to you would be, how many distributors are actively marketing catalog?
Well, I think that's the point. You're saying that you're going to move them to the lowest fee. You didn't say the lowest fee with the best services.
Yeah.
And so it's kind of what we're dealing with right now, where people are trying to move artists away from labels, thinking that labels are just the enemy, when in actuality, whether you build a team and do it yourself, it's still a label. All the functions have to be there to be successful. And so I think the problem we're running into right now is that a lot of artists are being duped into thinking that they can go out on their own all by themselves and do it themselves, when in actuality, every aspect of what a label would provide, they need. And so whether they get that in part from their distributor and some additional team members, or they have a label relationship, I think we're seeing more and more artists realizing they made a mistake trying to get their distributor to do some things that only a label can do. And I think giving them the advice to follow the fees as opposed to understanding the services could be problematic.
Yeah, and from RoyFi's perspective, we view that as a business decision that's handled between the artist, their management, and their label. And our main position is that we just want to complement what it is that you're trying to do and provide you with the resources, and you know, say that you're going to probably go ahead and find the best decision, whether that be with Tony and Beetroot, or whether that's going with a DIY. I think that's an individual decision that, you know, each team should be empowered to make, and we can work with, you know, similar to everybody else, any distributor that is or publisher that's willing to accept a letter of direction.
Yeah, from a sound royalties perspective, just like Matthew, we need to be and want to be paid directly. But the pricing, we work with over 130 payors, so but the pricing is really dependent on the acknowledgement we receive, right? Is it irrevocable letter of direction? You know, can the artist just phone up, like for example, Sound Exchange, phone up and say, hey, I changed my mind, just redirect that payment back to me. You know, that's we look at it from a pricing perspective, depending on the risk of the payor and how committed they are to ensuring that we're protected.
Got it. Thank you. All right. So to keep this, you know, non-biased as possible, is there still a world for a major label JV for an independent label?
I absolutely think so. Right? I mean, at least from our perspective, we need that. We want that. Right? We want major label JVs, indie labels to go out there and find the next big thing and find talent and nurture that talent and do all the things that Tony's mentioning that a label should be doing, right? That are extremely important. Where we come in is when that has happened, when the artist or the label is in a position of strength based on their data and can say, hey, I've generated this amount of money or I've generated this amount of traction, and now I'm willing to cash out, and I want to cash out for whatever reason, like we were saying before, working capital management, I want to go sign more artists or whatever. Hey, Duetti, give me a price. And that's where we can come in and acquire those, take that catalog off your hands, and you can go focus on what you do best and go sign new artists, right? That's not an area that we want to be in, that we think we're good at. We're not, you know? So I think, to answer your question, I think absolutely there's a place for that, right?
Yeah, I think a couple of scenarios that we've seen is when you have an artist that's really starting to grow, and there's a risk of them departing, and so that partnership allows for them to get a little bit more global exposure while retaining the relationship. So that's one avenue that we've seen those kinds of things happen, and then also that partnership can also be another source of working capital for a label that just needs some additional working capital to do the things that they want to do. And so there's an opportunity. There is always a very specific case for a major label partnership, but so I wouldn't say never, but as much as possible, we want people to stay independent.
I would actually say, Sam, if you get offered one, you should probably take it, and here's why, in my opinion. Major labels are losing market share in frontline music, right? Their influence is declining, and one of the ways they're trying to hold on to it is by buying independent labels or investing in independent labels who are having success, right? And independent labels are having more success than the majors over time, right? Their share is growing, the major share is shrinking. What that means is if you're having success at an independent label, there's probably going to be more than one major coming after you, which means they're probably going to be bidding, which probably means they're going to all pay over the odds. And if that's on the table, I'd take it and run.
It's the reason they're doing it, to your point, is to get deal flow from their perspective at the end of the day, right?
Right, but the corollary of that is there's, 10, 20, 30,000 independent labels in the world. These offers are going to come up 10 times a year, right? So it's a bit like saying to an artist, or asking the question, should an artist take a major label deal? Are they going to be offered one, right?
Well, no, I think it's a little bit more than that also because in a lot of ways the majors can't bank on virality. So in a lot of ways they're using independent labels as their A&R and their artist development because they're not doing as much artist development anymore. So they identify labels that they'd like to partner with. They feel are doing a really good job at artist development, and they're spreading their bets. Because the way I'm looking at it, you know, and I'm coming from the perspective, you know, having just been a serial entrepreneur, is that a label's a lot like a VC fund because you're making multiple bets, and you only need one or two successes to kind of cover your other bets. And so what some of the majors are doing, and I think smart people who are really wanting to move into the music space beyond just publishing catalogs, is they understand that this is kind of like a fund of funds. So if I can invest in 6 labels, and I can get a home run out of one of those labels, it covers all of my bets. And so so I do think that we're starting to see more sophistication and understanding that there's so many similarities between venture capital and what labels do, that I think sophisticated financial managers will want to get involved with labels and have a fund of labels. And so you're going to see more labels getting approached to help with the artist development side of things because, you know, viral moments aren't enough for the majors. They can't sustain their heft with just viral moments.
And that's why you see them coming in later into the game. I mean, the evolution of an artist, they're starting much later where they're coming in, and that's making room for the distributors to be that next level as they start to get traction. You know, from our perspective, we see it because we work with this, whether they're with independent, whether they're signed, whether they're recouped or unrecouped, you know, all aspects. But it's truly they're coming in much later than they did before. And if you have someone that's going to that level, you want to look at it if your book of business.
Yeah, one last thing on that. I think the nuance around, you know, what decision's right for you is you know, a personal one at both the individual and the label side. But what is kind of new and what I think all of us bring to the table is that just working capital or just access to money is not a good enough reason to go down that route because there are other options now. So if before you say, oh, well, we really need a JV to fund our next project, you know, I think it would behoove you to give us a call and say, you know, what are my options? Because I think that this industry is continuing to evolve and access to capital is not as difficult as it used to be.
Cool. And you mentioned virality. In the interest of time, I want to get to this because, you know, TikTok has, you know, obviously upended quite a bit in this business. And from a financial perspective, we've seen it completely skyrocket an entire artist's career, and we've also seen a song drop off overnight with minimal impact on the rest of the catalog. How do you all think about virality in this day and age, and how does it impact your view on value?
Everyone's looking at everyone else. It's a hard one. I mean, we will value tracks starting from 6 months old, right? So Flash is in the pan. I had a friend of mine who's a manager call me last week. He's like, oh, I've just signed this artist. She's blowing up. And the track had literally been out for 2 weeks. And it was streaming millions for sure. I said, Chris, I love you, man, but we can't do anything. Another Chris. But I said, we can't do anything with that. Now, he's actually just called me again, and a few more weeks have gone by, and we're looking at doing something. But virality is, it's really, really hard to know whether that actually exactly where the tail is, right? But we're getting better and better at tracking that with data science. But yeah, if you call me and say, I got a track that blew up in the last 2 weeks, I'm going to say, give me another 3 months and give me a call.
We don't really factor it into our valuations because it's not the core value of a track, right? We have a lot of situations where an artist will come to us and say, well, I've had 2 TikTok moments, so this track should be worth more perhaps, right? Or label, or I've had 3 syncs. And from our data perspective, past viral moment is not an indication of a future viral moment, right? So it's hard for us to include that in the core value of the track. Now, hopefully, when you had that flash in the pan, it wasn't just a flash in the pan, and it resulted in you going to a higher plateau or a higher level, and then that'll factor into the valuation. And one of the ways that we allow artists to hold on to that lottery ticket, so to speak, of another TikTok moment or another big sync, is they only have to sell us a portion of the track if they don't want to sell the whole thing. So you can keep anywhere between 0 to 50%, and we partner with TikTok, and we have had artists that have had successes after doing a deal with us, where we've had big TikTok moments. And we all know that sometimes they translate into actual dollars and cents, and sometimes they don't. But that's the way we handle it, at least. And to use your analogy, Tony, we look at ourselves not as a VC in that sense, but as a private equity, almost like later stage, more stable returns, less big swings, and so we don't rely on those viral moments either to drive the success of our fund. But again, it's a matter of marketing on the one hand to the artist, and it's a matter of valuation for us on the other, right?
And we're waiting for that virality. Someone comes to us with a 2-week-old track, the answer is going to be the same. But 3 months down the line, we're looking at that virality turning into music consumption. And as soon as it turns into music consumption,
Right.
we can quantify what's going to come in for the future. But we go out as far as 5, 6 years, typically have gone out as far as 9 years in terms of financing into the future. But when they come to us with that and it's 3 months old, we're going to be a much shorter window. It may be 6 months, a year, or 2 years that we'll offer financing for.
Right.
Yeah, I think similar to you, Alex. We can look at pipeline as well and provide a roll forward of what's in the pipeline for that viral moment, so that you do have some ammunition to kind of compound on that success and on that momentum. But one of the key components to our model is giving full credit for early recoupment, whether that's with outside funds or through organic performance. So from that perspective, you don't have any risk of paying off a 2-year advance in 1 year and then increasing your cost of capital by 2x. So what does that mean? You pay something off, and you're paying the same fee. That makes for a lot more expensive transaction. What we do is we actually have it built into our deals that if you pay off early based on specific dates that go as granular as monthly and sometimes even shorter, you don't have to pay for that money that you've recouped at a much faster rate. So therefore, obviously reducing the cost of the advance that you took on the front end.
Cool. Well, I want to save some time for Q&A, but I'll leave with one last question. This industry, at times the commercial points of an agreement can be quite confusing, particularly in a traditional sense. What are some of the key things for an independent label to look out for, when assessing and benchmarking their options? And then the second part to this question is, from a data perspective, what are the key factors for them to help understand their value when going into these conversations?
Well, from our perspective, it's really dissecting and separating the capital need, which you mentioned, I think you mentioned it, Tony, the need for capital versus the services or what else is coming with the money. And if you can separate those two, then you can look at that capital and the cost of that capital. And look at the different options and see what's out there. Maybe one's going to go out longer. Maybe one's going to provide a little more flexibility, whatever it may be, but really separating the two and then comparing the options. There's 13 to 15,000 banks in the United States. I keep seeing different numbers, so I keep quoting different numbers, but there's plenty of room for them, right? In the music industry, 10 years ago, there weren't a lot of options from music finance perspective when we came onto the scene. And now there are options. So take advantage of understanding the different options. They're all viable companies and viable options out there. There are a lot of them. And it's a good thing.
Yeah, I would say, from the advanced side, so as it pertains to beatBread, Sound Royalties, and RoyFi, I think it's important to know that we're similar to a regular business looking at the debt side of any equation. So I think it's important to note that once you pay off the amount that you owed, that there are no other strings attached, because we're not providing equity financing. We're very confident. The reason we'll put money out the door to any deal is because we know that we're going to collect it back, just similar to a bank. we're not taking that next level of risk where we would need to have, an additional kicker or some tentacles into the deal where, hey, if you do this, then we collect 5% on the next, 2 or 3 years. That's not necessary from our underwrite and from our risk assessment. So I would just be cognizant of that, because at the end of the day, these earnings are really important to you and your business, and are going to be what helps to move you forward and be successful.
I just say, Sam, I think we've all tried to build products that are really transparent and really helpful to the clients that they're aimed at. All I'd say to anyone in any case is read the contract, make sure you know what you're signing.
Yeah.
Yeah, absolutely.
All right. Well, we've got 6 minutes left. I want to open it up for some Q&A. Cool.
I think there's a mic coming. There is.
Thank you. Hi, I'm Chris from the Latin American Observatory for Independent Music. So one of our key findings during these years is that funding is the key problem in Latin America to grow up and to actually try to get down all of the money that is getting to Latin America with a very good catalog in different genders. So, and actually the context that you can go to banks now is very, forget about it. If you go to distribution, they have awful contracts, like very aggressive. And so there is like I think this is a good solution for the market in general. So do you have any plans or strategy to go to Latin American catalog? And for sure you have, no? But a strategy more maybe going to the labels, or maybe like a regional strategy could be different. Like you have to change language. There's a different culture also of professionals. So I don't know if you have any idea to go to Latin.
Great question. So we actually have an office in Bogota and full-time staff, and work extensively in Latin America. Actually, we work in finance and fund creatives and distributors in 16 countries.
Yeah, and from our perspective, we can work with artists anywhere around the world, and we have in probably about 7 or 8 different countries now. We predominantly work in U.S. dollars. That's the way that we work, but we can always do a transaction to local currency, as long as, again, we can get an assignment in place with the entity that's paying those royalties to the artist.
Yeah, we've definitely done deals all around the world, and definitely looking to do more business in Latin America. And I think translating more of our contracts, probably for all of us, into Spanish would be helpful, right?
Yeah, ours are. So.
Okay, well. Okay, my name is Steve, and full transparency, I work for Tony, and I'm with beatBread, and I'm a RoyFi client, just letting you know, and you guys probably know me, but the question I have is, how do you factor in like a one-time successful co-collaborator when you're looking at catalog valuations for whichever product? Very often a catalog has maybe, not the viral thing, but it's working. One release had a really prominent collaborator that may not happen again.
Well, my answer to that is really easy. We value one track at a time. So we would value that track based on its performance with that co-collaborator, and the other tracks in the catalog would be valued individually.
Same, but I would say I would add that if there's futures in the mix and there's unreleased works, comping that track for to get an idea about what an unreleased work might do. In my perspective, that it would impact that. Like we would need a contractual lock on a similar feature to use that as a comparable earnings estimate.
And from a financing perspective, it doesn't matter how we treat it, because you still own it and whatever it does in the future. So if it hits, it hits. You're not leveraging the entire catalog. You're financing or advancing against some of the income stream. So any of those hits coming in the future, whether it was factored in or not, theoretically you didn't leverage everything possible you could out of that catalog and took every dollar or penny out of it, right? So you have more flexibility to see it successful and are more vested in seeing it successful. I'm always worried of someone that does want to sell 100% of it and say, well, it was one time, but it's going to happen again. Well, then why are you getting rid of it?
Hey, what's going on? Hey, what's going on? Nice on the Sonics. I'm an audio engineer. So I have like a whole bunch of independent clients. Like I work with a lot of clients, like about like 100 and something like a month. And the question that I get often is like how to put together funding or to pitch for funding when you don't have like that much traction in your music yet. Like you need funding in order to get your music going in a particular way, or to pay for playlisting, or to pay for particular things. Like, what do you feel like is the best way to raise funds in that early part of your career process where you're trying to get the ball rolling, just so you can prove that you can sell music and get better, bigger funds later on?
I mean,
So my recommendation is to encourage your clients or your those that you collaborate with to get the right team around them, because it's that team that's going to help draw the capital. So to use the venture capital analogy again, VCs invest in people, in teams, where they're investing on track record. And so if you're going to be able to find funding, you're going to have the right team around you of people who have relationships, that those relationships are going to be the currency in which people are going to be able to give you some of that original capital. And then after that, you build that track record, and now you have cheaper capital that you can get from these gentlemen here and their businesses, because what they're providing is extraordinary. But if you don't have a track record, there's very little you're going to be able to get. And so you want to get to the point where you can use them, because the capital they're going to provide is much cheaper than any other capital you're going to be able to secure. So having the right team around you is very important. So I think that's the first step. So before they start looking for money, they need to try to find some people that believe in them, that are going to be able to help open some initial doors for that early capital. Here's the challenge, and this is, and Sharon, you probably know this very well. A lot of times, artists, they use money as a surrogate for belief. So they say, if you believe in me, you'll give me X number of dollars. But belief comes in a lot of different ways. And so there are some ways to believe in and support an artist that doesn't translate into money. And the music business is a relationship business. And so if I believe in you and I'm willing to open up my network to get you access to some things you couldn't get on your own, that is belief, even though I may not have written a check. That's the kind of early investment that these artists are going to need to get to the point where they can put out content, start generating a track record, so that then they can go and get capital from these businesses. No.
We've got time for one more super quick one.
Yeah, so the idea of, I just want to like backtrack to the idea of like resources after the initial advance, the payout, and specifically, I know Matthew, Peter, and who else does advancing for advanced funds, and STEM specifically, right? So,
Sound royalties.
and sound royalties. Okay, yes. Okay, so, you know, the idea of resources for the artist after the initial advance, what is the incentive for like an artist or a label to work with each of you fintech companies, you know, comparing their options? Like, what are the best options for them aside from just the initial advance payout? And like, yeah, just to riff, I think like, Tony, you touched on the idea of like, you know, what else is there? Is there a marketing, or what are the other resources available? So if you can like expand on that, I'm just curious to hear your thoughts.
Yeah, none from us. We don't provide any services at all. We just provide financing and leave you to it.
Okay.
Yeah, a little bit different from STEM's perspective. You know, we're a invite-only distribution platform as well. So one of the reasons for that is to, you know, provide each of our clients with, you know, a dedicated rep to help them maximize the value of their existing catalog, but also new releases, which directly plays into when we're financing new releases as well. That's why we pay, you know, such particular attention to the music and the creative plan for it as well, so that we can service that as best as we can.
And there's, you know, you got to look at it from two parts. There's financiers and there's investors. Investors are going to be vested in seeing the growth with you and provide services. Financiers give you the ability to get the funding and go find partners and say, listen, I need your help. You can work with me. Let's partner on this, but I don't need money. Or you can match my money, right? But you have a lot more flexibility to go to people that can provide the creative services, separating that without the need for funding.
Yeah, I think that there's nuanced differences between all of our models, so it's really up to you as to what makes the most sense. But RoyFi does not provide marketing services or other ancillary services ourselves, but what we've done is we've curated a list of partners in the industry that we think are good actors that actually have a real value proposition, and then we've negotiated different incentives to work with them that directly benefit you from a revenue share back to you that helps recoup your advance, or just in general lower cost access to different services.
And I think that's a wrap. We're a little over time, so thank you very much for coming, everyone, and thank you to the panel.